Good morning, everyone, and welcome to today's webinar. I'm delighted to be your host alongside Victoria. Together, we bring a collective 20 years of experience in the taxation field. Throughout the webinar, we're going to provide you with some tips on tax savings, both on a personal level and within the context of a limited company. We're not going to be having a dedicated question and answer session during the webinar, but you can anticipate receiving the slide handout afterwards. Additionally, along with the slide handout, we're going to share a 15-minute booking link for complimentary discussion with myself or Victoria. During the session, during that 15-minute session, we're happy to assess potential tax saving strategies tailored to your individual or your company needs. Just a bit of a disclaimer with regard to today's webinar. The tips shared today are general in nature and they don't constitute personalized advice. Each situation should be evaluated on an individual basis. If you are considering implementing a specific tip that we chat about today, we do strongly recommend that you do reach out to a tax advisor beforehand just to discuss your unique circumstances. Before we get going today, on the tax tips, we're going to just start off with a bit of a poll. We do like an interactive session, and while we're not going to have specific interaction from a Q&A perspective, we'd like to get everyone on board from a polling perspective. So let's start with our first poll of the day. I'm just going to launch it now. The first poll of the day is, do you know what your latest taxable liability was, whether it's self-assessment or your corporation tax from your limited company? So this is just a single choice, and the options are: was your taxable between £0 to £5,000, between £5,000 to £20,000, more than £20,000, or are you unsure of what your taxable was? Just going to give everyone a bit of a chance to complete the poll, and then I will end the poll and share the results before we go into some of the tax tips. Okay, I see more people are just completing it now. Just give it a few more seconds. I see there's still people completing. All right, let's end the poll, and I'm just going to pop the results up for everyone to see. Right, so we've got 43% of everyone today with a bill of between £0 to £5,000, and 57% of people with a bill of between £5,000 to £20,000. I'm glad that no one ticked the "I don't know my tax bill" answer. It's always great to see this, and often when we see people ticking the £0 to £5,000 bill, it's always great to also know, even if your tax bill was zero, there are still options for tax saving tips, from either carry forward for future losses or for trading in those losses for a tax injection. So let's go through some of our tax tips today, and then there'll be a few more polls throughout the session.
Thank you, Erin. Our first tax tip for the day is trivial benefits exemption and the annual party and social functions exemption. Trivial benefits exemption allows employers to provide certain low-value benefits to their employees without incurring tax or national insurance contributions. This exemption is designed to simplify the tax treatment of minor benefits and reduce administrative burdens for employers. The qualifying conditions are that the benefit must cost £50 or less. It must not be a cash or cash voucher. It must not be a reward for work or performance related. There is no limit on the number of trivial benefits an employee can receive in a tax year. However, directors of closed companies, those owned by a small number of shareholders, are subject to a cap of £300 per tax year. Employers do not need to report trivial benefits to the HMRC or pay tax on or national insurance. Examples of trivial benefits are a small gift to celebrate a special occasion, such as a birthday or a wedding, a seasonal gift such as a turkey, bottle of wine, or box of chocolates, flowers on the birth of a child. This exemption applies equally to benefits provided to the employee or to a member of the employee's family or household. The exemption also applies where the trivial benefit is provided on behalf of the employer by a third party. For example, where the benefit is provided through a management services company within a group of companies, or by a third-party business where management services have been outsourced, provided the cost of the benefit is ultimately borne by the employer. There is also provision for annual parties and social functions by employers to their employees. This section provides an exemption from income tax for the costs associated with such events, provided certain conditions are met. The conditions are that the exemption applies to the costs incurred by an employer in providing annual parties or other annual social functions for employees. The event must be open to all employees or to all employees at a specific location if the employer has multiple locations. The exemption is available for costs up to a reasonable limit per attendee. The cost per head, including that, should not exceed the limit of £150 per person. The exemption is applicable to only annual events. However, if an employer provides more than one annual function for its employees, the total cost of these functions must not exceed the limit per head. The £150 is not an allowance, but the threshold for the full exemption. If the cost exceeds the £150, the full cost is then chargeable for employees and their family members attending. The other great thing is that virtual functions are eligible for the exemption if all the conditions are met. Employers do not need to report the costs or benefits associated with qualifying annual parties or social functions to the HMRC. These exemptions are designed to simplify tax procedures for minor perks, fostering a positive work environment by enabling employers to offer low-value benefits without the administrative burden of taxation, thereby benefiting both the employer and the employee.
Our second tax tip of the day is around pension contributions, which is always such a great tip. I'm sure you've heard of it before. So there are two ways that you can pay into a pension fund. Both offer significant tax advantages. You can either opt to make a personal contribution, or you make them through your limited company in the form of a company contribution. So let's look at the two options, diving into the tax implications of each to help you make a more informed choice around this. So when you pay into a pension scheme out of your own income, so that's after tax money, you'll receive a tax relief based on the income tax band that you fall into. So if you're taxed at the basic rate, at the 20% rate, then for every £80 you pay into your pension pot, you'll save £100, as you'll receive a 20% top-up by HMRC, which is paid directly into your pension pot. Currently, there is no limit on how much you're allowed to pay into a pension, but, and this is a big but, there is a limit with how much you can invest and still claim tax relief on. So this is currently set at 100% of your earned income, and that's up to £60,000 a year, and that £60,000 is known as the annual allowance. If your income is below £3,600 per year, then you can pay up to this amount and still get 100% tax relief. So the other option is to pay into your pension through your limited company in the form of an employee year contribution. So as employer contributions are an allowable tax expense, your company is going to receive a corporation tax relief, meaning your company could save a minimum of 19% of tax. Now, that is the lowest level of corporation tax for this tax year, being 2023-2024. Another benefit of paying to the company is that the employers aren't required to pay national insurance on those pension contributions. If you consider that the employer's national insurance rate for 2023-2024 is set at 13.8%, you could save up to that amount by paying into your pension rather than taking the equivalent as a salary. For the company, that saving could almost be up to 30% if the money was paid straight into your pension fund and not as a salary or a bonus. It is important to note that any contributions that you make have to abide by the existing pension rules in order to qualify for the tax relief. So HMRC states that the pension needs to be wholly and exclusively for the purpose of business. And to assess if this is the case, HMRC can ask for evidence to see if anyone else in the company is benefiting from such arrangement.
Thank you, Erin. Let's move on to the creative sector tax relief. This is a wonderful relief for the specific sectors that we're going to speak about now. The government offers several tax reliefs for the creative sector to encourage investment and support the growth of specific industries. These creative sector tax reliefs are designed to benefit businesses and individuals engaged in qualifying activities. Here's a list of the creative sector tax reliefs. We have the film tax relief, the animation tax relief, the high-end television tax relief, video games tax relief, children's television tax relief, theatre tax relief, orchestra tax relief, museums and gallery exhibitions tax relief. So you can see the list is quite extensive. The qualifying criteria vary, however, here are the general ones. You have to be certified as British by the British Film Institute, the BFI. It has to be intended for specific purpose.
So it is taxed like any other. Is taxed like any other income. You do obviously have the benefit of using your personal allowance against that pension income. And I think Victoria is back.
Apologies for that. As I was saying, the qualifying criteria is that you have to be certified as British by the British Film Institute, the BFI. It have to be intended for specific purposes, being theatrical release, broadcast, and etc. The minimum percentage of your core costs has to be related to the UK activities, and specific requirements based on the type of creative projects will also apply. Additional deduction based on a percentage of total or UK core costs applies as the relief. The lower of 80% of the total core costs or the amount of the UK core costs may be deducted. There's also possibility to surrender your losses for a payable tax credit. If you're making a loss, it can be surrendered for a payable tax credit at 25%, which is quite significant. The rates do vary for each creative sector tax relief, but they all range about 25%. Companies can claim these reliefs on their company tax return and must provide evidence to support their claims. The rates and criteria vary for each relief, so it's essential to review the specific guidelines for each creative sector tax relief. Thank you.
Okay, sorry, Victoria, I think we missed a little bit there. We lost you a bit. Let's move on to research and development, and if there are questions around the sector relief, then we can answer them in the chat box. So our next tax tip is around research and development. This is a great incentive, and I think often when people think of research and development, they often think of something quite scientific or technological. It actually applies to quite a wide range of industries and sectors, so it's always important to be assessed. The UK introduced this research and development, also known as R&D, and I'll refer to it as R&D as we go through this tip. So they released this in the year 2000 to encourage scientific and technological innovation within the UK. So it's such an excellent opportunity for UK businesses to receive tax incentives, either when they invest in research and development. So the scheme rewards past R&D spend, but it also encourages future investments. If your business invests significant amount of time, money, and resources in either developing or improving products, processes, or services, then you might be entitled to receive quite a generous R&D tax relief. If your company is profitable, you can use the claim to reduce your company's tax bill to a greater extent than the current standard deductions. If your company may be facing losses, there are still advantages to claiming. So you may be given the benefit of additional losses that you can carry forward to future tax years, and you can use those when the company is profitable, or the losses could be surrendered in that tax year for an immediate cash benefit. The cash injection may be a welcome relief when your company is on the early developmental stages of the product. So to make an R&D claim, there are some specific criteria that your business must meet. So it must be subject to UK corporation tax. So generally means that it's registered in the UK and is a limited business. Secondly, you must actually be performing research and development. And then thirdly, there must actually be money spent on that R&D. The other two main criteria from HMRC in order for it to be considered R&D for tax is that there must be some sort of technological advance. And then secondly, there must be a resolution of some sort of technical uncertainty. There are two main types of R&D relief. The first one being the SME, so that's small and medium-sized enterprise relief. And then the second one is research and development expenditure credits. From next year, April, HMRC is going to merge both of those reliefs together. The enhancement rate is currently 86%, so that means you could get up to 186% deduction. And the tax credit to trade those losses in is currently at 10%. It used to be at 14.5%. Some companies are still allowed to claim the 14.5% if they are deemed to be intensive R&D companies.
Thank you, Erin. On to the next tip. We will talk about health screening assessment or medical checkup expensing. If you're an employee of your limited company, you can expense the cost of a health assessment provided by your company without incurring income tax liability. You can only expense one health screening assessment or medical checkup provided by your limited company in a tax year. The assessment or checkup must be conducted by a health professional and should solely be for the purpose of determining your state of health. There is no liability to income tax in respect of the provision on behalf of an employer of a health screening assessment or a medical checkup for an employee. However, there are limitations on the number of assessments provided. No more than one health screening assessment can be provided in a tax year by any one employer or by any combination of employers of the employee at the same time. Similarly, no more than one medical checkup can be provided. The definitions and the difference between a health screening assessment and a medical checkup are: a health screening assessment is an evaluation designed to identify employees who might be at particularly risk of ill health. And a medical checkup is a physical examination conducted by a health professional solely for determining the employee's state of health. You do not have to report anything to the HMRC or pay tax and national insurance on the health screening benefit, and there is no benefit in kind is created either. It's free when utilized through your limited company, so do take advantage.
Our next tip is around a company car and is it worth it? So to keep things simple, this tip pertains to company directors buying cars. So as a company director, you've got two options when it comes to buying cars. Either you buy it or lease it yourself, and then you claim the business mileage as an expense, or the company buys or leases the car, and then there's some tax break on some of the costs using that option. So the first option, claiming mileage, is usually more tax efficient unless you're buying a fully electric car or a hybrid with very low emissions. So directors are classed as employees and are therefore subject to benefit in kind tax for their private use of any car owned by the company. The benefit in kind value is based on the car's list price, the fuel type, and then the carbon dioxide emissions. Moreover, the company will have to pay employers' national insurance on that value of the benefits. Although the company can reclaim some running costs and a portion of the purchase cost, thereby reducing the corporation tax in the company, the benefit in kind tax and employers' national insurance on company cars means that directors almost always save tax overall when they buy or lease their car privately and then claim the mileage allowance. Benefit in kind tax and employers' national insurance also applies to leased cars, so not outright purchased cars as well. So even if the company leases a car rather than buying it, claiming the business mileage, it's usually your best bet. However, there are a couple of exceptions, and we are seeing that this is becoming more popular. So the rule for benefits in kind on electric and hybrid cars changed from April 2020. So it means that if you are buying an electric car with no CO2 emissions or a hybrid with very low CO2 emissions and a high pure electric range, it might be more tax efficient to buy that car through your company rather than buying it privately and then claiming the mileage. Now, everyone's situation is so different. So if you are considering an electric or a hybrid car, it's definitely worth contacting a tax advisor just to crunch those numbers. If the car is a pool car, then you should definitely buy it through the company. A pool car is a car that's available to all employees, and no employee is using that car privately. It's parked at the business premises, so not at the employee's or the director's home address. Currently, the business mileage claim rates are 45p per mile and for the first 10,000 miles, and 25p per mile for any further miles above that 10,000 mile cap, and that's per annum. So your company reimburses you for this amount and puts it through on its accounts as a business expense, reducing its profits, reducing its corporation tax. There's no benefit in kind tax on that. It is important to note though, and this is where you really need to crunch the numbers, if you are using the mileage method, then the cost of the vehicle, the maintenance, the fuel, the insurance, the road tax, they've all got to be paid for privately as a director. You can't claim these as an expense to the company as well.
Thank you, Erin. Let's move on to the use of home for office for business purposes. So if a lot of you do work from home, this is where you need to pay attention. Deductions for home office expenses, the fixed rate rules. If you're self-employed and work from home, you can get deductions for certain expenses. The amount you can deduct depends on how many hours you work at home each month. For example, if you work 25 hours or more, you can deduct £10 per month for household running costs. If you work 51 hours or more, you can deduct £18 a month. And if you work 101 or more hours, you can deduct £26 per month. This rate covers things like heating, lighting, and water charges, but not fixed costs like mortgage or rent. Treatment of home working expenses for employees. If your employer pays you for extra expenses when you work from home, it's tax-free if it's reasonable. Extra expenses could include heating, lighting, and business calls. Employers can simplify this by giving a flat weekly payment of £6 without needing detailed records. And lastly, we have the non-exclusive rental agreement. People working from home might set up a rental agreement with their employer or with their limited company. Rent paid can be deducted by the business from taxable profit if it's a fair amount. A formal agreement is a good idea, and regular evaluations by an expert support this. To prevent tax issues, the agreement should state that facilities are only let for specific hours each week. Rent received is declared on the individual's tax return, and it's subject to usual expensing rules. It's important to note that the property allowance, which is £1,000, isn't applicable here due to the connection between the payer and the payee. If you work from home, you can get some money back for certain expenses, whether you're self-employed or working for someone else. Just make sure things are agreed upon properly and you keep things like rent fair and reasonable. Remember, there are some tax rules to follow, so it's good to know what you can and can't do. Always good to speak to your tax advisor.
Thanks, Victoria. Our next tip is around overseas workday relief, and this is for any of our expats. So overseas workday relief is a tax benefit accessible to UK non-domiciled individuals, and it's for those who are utilizing the remittance basis of taxation while they're working abroad during the tax year. So the provision allows the non-domiciled individuals to lawfully exempt themselves from paying taxes that are derived from UK employment when their duties are conducted either entirely or partially overseas outside of the UK. So typically, anybody who is a tax resident in the UK would be paying UK tax on their worldwide income. However, many non-domiciled individuals working in the UK are often required to travel abroad and work outside of the UK as part of their normal employment duties. So if they are claiming the remittance basis of taxation, if they were considered a UK non-resident for the previous 3 tax years and they're currently UK tax resident in the tax year in question, then it's possible to claim a tax relief on the employment income earned abroad using this specific relief. So one of the key criteria to mitigate paying tax on this foreign earned income is to ensure that the money earned is paid directly into an eligible non-UK bank account. So while all tax resident non-domiciled individuals are eligible for this workday relief, the real benefits are for those non-doms who are earning in a higher tax bracket. So that's over £125,000 per year. It's such a valuable relief, and it's not often used when it's actually widely available to quite a few expats. So if someone who met all the criteria, if we just put it into numbers, let's say they earned £125,000 per annum, and let's say as a result of their employment, they were required to work outside of the UK for 10% of the tax year, their saving, if they were to apply this relief, would be £5,625. Most of the time, we wouldn't anticipate the employment income being taxed in the overseas country where the services are being performed. but again, that does depend on specific circumstances.
Let's move on to the marriage allowance. It is also known as the transferable tax allowance. This allowance allows individuals to transfer 10% of their personal allowance, which is £1,260 in the 2023-2024 tax year, to their spouse or civil partner. To qualify, neither partner should be a higher rate or additional rate taxpayer. The transferor, the one giving the allowance, reduces their personal allowance by the transferred amount, and the transferee, the one receiving the allowance, gets income tax relief with a 20% reduction of the transferred amount in their tax calculation. This allowance is advantageous when one partner can't use their full personal allowance and the remaining income would otherwise be taxed at 0%. It's particularly useful for basic rate taxpayers, and if the transferee dies in the tax year, the transferor's personal allowance isn't reduced. The qualifying conditions is that both partners must be entitled to a personal allowance and not be a higher rate or additional rate taxpayers. As well, the complexities may arise for non-resident and Scottish taxpayers due to the differing tax rates. Method of tax relief. The transferee receives relief through the 20% tax reduction of the transferred amount. And for employed or PAYE pension recipients, the relief is often applied by adjusting the personal allowance in the PAYE code. The transferable tax allowance in the case of death. If the transferee dies during the year, the transferor's personal allowance isn't reduced and the deceased entitlement to the tax reduction still remains. The surviving spouse or civil partner should make the election after the death to maximize their income tax relief. In essence, this allowance is a way for couples to optimize their tax position by making use of any unused personal allowance, ensuring that both partners benefit from available tax relief.
Thanks, Victoria. Our tip number 10 of the day is around personal savings allowance and the starting rate for savings. So most people can earn interest from their savings without paying tax. Your allowances for earning interest before you have to pay tax include your personal allowance, your starting rate for savings, and then your personal savings allowance. You get these allowances each tax year, and how much you get will depend on your other income. So you can use your personal allowance to earn interest tax-free if, of course, you haven't used it for your other income, being wages, pension, rental income, or anything else that is deemed to be income. You may also get up to £5,000 of interest and not have to pay tax on it. And this is your starting rate for savings. The more you earn from other income, the less your starting rate for savings will be. So if your other income is 17,570 or more, then you're not eligible for the starting rate for savings. If your other income is less than £17,570, then your starting rate savings is a maximum of the £5,000. For every £1 of other income above your personal allowance, that then reduces your starting rate for savings by £1. You may also get up to £1,000 of interest and not have to pay tax on it. And this again depends on which income tax band you're in. And this is called your personal savings allowance. So if you are a basic rate taxpayer, you get £1,000 of personal savings allowance. So up to £1,000 will be tax-free. If you're a higher rate taxpayer, this reduces down to £500. If you are an additional rate taxpayer, this reduces to 0. So this allowance applies to interest from bank and building societies, savings and credit union accounts, unit trusts, investment trusts, peer-to-peer lending, trust funds, payment protection insurance, government bonds, company bonds, life annuity payments, and then in some cases, life insurance contracts. So if you have a joint account for savings, then just note the interest is going to be split equally between the account holders, but you still get your full allowances. That brings us to midway through our webinar. And before we move on to our next tax tip, we're just going to do our second poll of the day. Right, I'm just going to see Mel. Sorry, everyone. It doesn't seem like I'm able to bring up the polls. Would you be able to see your side? Or Victoria? It's indicating I'm not logged in.
It should be launched now. Our midway poll is trade in or carry forward. If a relief was available to you where losses could be traded in, would you prefer a cash payout by HMRC or a carry forward to future tax years? Please, if you could select one of the two options, either yes, I would opt for the cash payout, or no, I would carry forward my losses and get a relief in the future. All right, I'm going to give everybody a few minutes to answer. A few more minutes. We see most of you have answered already. And a few last seconds, then we will close the poll and share the results. All right, I'm going to end the poll now and share the results. Great, so it looks like 55% of you would opt for the cash payout, and 45% of you would choose to carry forward your losses and get a relief in the future. Again, this is very specific to each of your situations, but I would suggest perhaps taking us up on our 50-minute chat so we can see which would suit you best.
I think it's always such a great thing, and I like that it's 50-50. And I think it's so specific to where you are in you know, in whether you're a limited company or personally, but sometimes to get that cash injection to actually boost the company is sometimes a better option than waiting for potentially bigger savings in the future, but maybe the benefit might not be you know, as beneficial as a cash injection. Great, let's move on to our next tax tip.
Thank you, Erin. For those of you with little ones, I think you must pay attention to this one. A child tax credit is a financial support provided by the government to help families with the costs of raising children. It is designed to provide assistance to parents or guardians with the daily expenses associated with bringing up children. You can only make a claim for child tax credit if you already get working tax credit. The amount you get depends on when your children were born. If all your children were born before the 6th of April 2017, you would get the child element, which is up to the £3,235 for all your children. And you would also get the basic amount known as the family element, which is the up to the £545. If one or more of your children were born on or after the 6th of April 2017, you could get the child element of child tax credit for up to 2 children. You might get an extra one depending on certain exemptions, and you will only get the family element if at least one of your children was born before the 6th of April 2017. Child tax credit is beneficial as it provides financial support to families by offering tax credits for each child, helping to reduce their overall tax liability for eligible individuals.
So whilst not a benefit per se, I think submitting and paying tax on time is often overlooked. So make sure you don't miss the deadline for taxes. It's a costly and easily avoidable mistake. For online self-assessments, your submissions are due by the 31st of January next year, so 2024, and that's for your 2022-2023 tax return. If you wanted to file on paper, the deadline was 31st of October 2023. Miss the deadline, there's an automatic £100 fine, even if you don't owe any tax. And there are additional penalties if your submission is 3, 6, or 12 months late. And then further separate charges if you haven't paid your tax bill on time.
Let's move on to the dividend allowance. The dividend's null rate band allows tax-free income on the first £2,000 of dividend income. It falls within the basic rate and higher rate tax bands, utilizing part of these bands. All taxable dividends must be reported on the tax return, even if no tax is payable due to falling within the dividend null rate band. There are some changes coming about to this. For the 2023-2024 tax year, the dividend null rate band is going to be reduced to £1,000 and then further reduced to £500 for the 2024-2025 tax year. Taxpayers receiving the dividends below £2,000 who don't currently file tax returns should notify HMRC if tax is owed due to these changes. The tax rates beyond the null rate band for the 2022-2023 tax year are for the dividend null rate band 0%, the ordinary rate band 8.75%, the dividend upper rate band is 33.75%, and the dividend additional rate band is 39.35%. The dividend null rate band is beneficial for tax planning as it provides individuals with tax-free income of the initial portion of their dividend earnings, allowing for greater tax efficiency within the specified band.
Our next tax tip is around the transferring of assets. So transfer of assets between spouses, so that would be husband, wife, or civil partner, generally bear no capital gains consequences. When the ownership of assets are shared between the couple, so are any of the potential capital gains in respect of any future disposals of those assets. The current capital gains allowance is £6,000, meaning any gain below £12,000 is shielded from capital gains tax if that asset is shared between spouses. The allowance is set to reduce next year to £3,000 per person, so the timing of disposal is always crucial from a tax planning perspective. If your spouse is in a lower tax bracket, you may pay more favorable tax rates by transferring those assets. So such assets may include an investment. So any interest, dividend, or return would then be taxed in your spouse's name at the more favorable lower tax rates.
Let's move on to individual savings accounts, or ISAs as they're known. ISAs are tax-free investment funds available to UK residents, originally for those over 16. Junior ISAs were introduced for those under 16 in 2011. Lifetime ISAs offer a 25% government bonus, up to £1,000 per year, with conditions on withdrawal. Benefits of ISAs include no tax on income or gains within the ISA, no tax on capital gains upon encashment, and no minimum holding period. Withdrawals can be made at any time. The types of ISAs are stocks and shares ISA, cash ISA, innovative finance ISA, lifetime ISA, and a help to buy ISA. There is an annual subscription limit. So the ISA allowance is £20,000 per tax year. Up to April 5th, 2024, an individual can invest with one ISA provider per tax type per tax year. However, the government will allow multiple subscriptions to ISAs of the same type every year from April 2024. Who can invest? Qualifying individuals must be 16 years or older for cash ISAs and 18 years or older for stocks and shares ISA or an innovative finance ISA. Qualifying individuals must be UK residents or non-residents in Crown employment. Transfers and repairs, repayment of funds in the same tax year is allowed. Balanced transfers between providers are permitted without affecting the annual investment limits. And then from April 6th, 2024, it is expected that partial transfers of current year ISA subscriptions will be allowed as well. ISAs of a deceased spouse or civil partner, surviving spouses and civil partners get an additional ISA allowance equivalent to the value of the deceased's ISA. The survivor can contribute up to the value of the deceased ISA into an ISA in their own name. The survivor does not need to inherit the deceased ISA to qualify for the additional ISA allowance. Junior ISAs were introduced in 2011 as an alternative to child trust funds, providing tax-free savings for children under 18 without the government contribution. There are two types of junior ISAs available, being the cash and stocks and shares ISAs. Funds in the account are owned by the child and are inaccessible until the child turns 18. Only one junior cash ISA and one junior stocks and shares ISA are allowed per child, but transfers between accounts are possible. All income and gains within the accounts are tax-free, but losses are not allowable for tax purposes. The annual contribution limit for junior ISAs is capped with an allowance of £9,000 per tax year. It is a lot lower, considerably lower than the adult one, which was at £20,000. Eligibility and account opening. A child is eligible if born on or after 3rd of January 2011, or born before this date without eligibility of a child trust fund account. The child must be a UK resident or employed overseas in Crown services with earnings subject to UK tax. The application to open the junior ISA must be made by an adult with parental responsibility for the child, who becomes the registered contact. Children cash ISA, with addition to holding a junior ISA until April 2024. Withdrawals from junior ISAs are generally not allowed until the child turns 18, except in cases of terminal illness or death. On the child's 18th birthday, legal ownership of the investments transfers to the child and the account ceases to be a junior ISA. The child receives information about future saving options with the likelihood of rolling the investment into an adult ISA. The main drawback is that the child gains full access to the funds at 18, which may not align with the parents' preferences, especially if the fund has grown significantly over the years. The upcoming changes that I mentioned, which are worth noting, are that multiple subscriptions to ISAs of the same type will be allowed from April next year, and partial transfers between ISA providers will also be permitted. ISAs and junior ISAs serve as effective tax planning tools by providing tax-free growth, investment flexibility, accessibility, and government bonuses, enabling individuals to optimize their financial strategy while minimizing tax liabilities.
Thanks, Victoria. Our next tip is around investing, specifically with SEIS. So the government set up the Seed Enterprise Investment Scheme as an initiative to incentivize investment in seed stage and startup companies by offering tax relief benefits to private investors who invest in these businesses. The aim of this relief was to stimulate the growth of the economy and encourage entrepreneurship. So SEIS investors must be UK taxpayers to take advantage of the scheme. An individual can invest up to £200,000 under SEIS in each tax year. SEIS investors qualified for a wide range of tax relief, and this is a great tax relief. So the first one is income tax relief. So the investor can get up to 50% income tax relief offset against the amount invested. The second relief is capital gains tax relief, and this is in 2 tranches. The first is 50% of capital gains tax relief on gains from an investment that's held in a non-SEIS company, if those gains from that disposal from the non-SEIS company are then reinvested into an SEIS eligible company. The second aspect of capital gains tax is there's no capital gains tax on any gains from the SEIS investment, as long as the shares are held for at least 3 years. The third relief is called loss relief. Loss relief is if the business performs badly, the investor can claim this relief equivalent to their highest rate of income tax. So if they are an additional rate taxpayer, it would be up to the 45%. The final relief around SEIS is inheritance tax relief. There's no inheritance tax on SEIS shares as long as they are held for at least 2 years. So tax relief can be carried back to the previous year as long as the investor hasn't already invested the maximum they allowed under SEIS in that tax year. It's also important to know that certain family members can't claim SEIS relief if they're closely involved within the company, because they would count as an associate. So associates include spouses, civil partners, parents, and children, but not siblings. So siblings are able to invest in another sibling's company. Associates don't qualify for any SEIS tax relief if they're an employee or if they own more than 30% of the shares in that company.
Thank you, Erin. Let's move on to venture capital trust scheme. Venture capital trust is a company similar to an investment trust. VCTs, as I'm going to refer to them, invest in small unquoted companies by subscribing for shares or lending money to them. The scheme aims to encourage investment in small unquoted companies, providing tax relief for both the VCT and the investor. Tax advantages for approved VCTs include that the approved VCT is exempt for corporations tax on chargeable gains, and losses for chargeable gains purposes are not allowable losses. Tax advantages for the individual investor. We have the front-end income tax relief. Individual investors can claim front-end income tax relief on subscriptions up to £200,000. The second one is the income tax exemption of dividends. Investors are exempt from income tax on dividends related to the ordinary shares acquired within the permitted maximum of, again, £200,000. And thirdly, we have the CGT exemption on disposal of shares. Individual investors are exempt from the capital gains tax on the disposal of ordinary shares acquired within the permitted maximum of £200,000. The VCT scheme is structured to benefit both investors and small unquoted companies by providing investors with tax incentives and supporting the growth of qualifying businesses. Investors in VCTs play a crucial role in fostering innovation and development in the small business sector.
Our next tip is around shares through employment. So if your employer offers free shares or the right to buy shares at a preferential rate through some government-approved scheme, such as a share incentive plan, a company share option plan, or an enterprise management initiative or incentive scheme, then the value of shares is exempt from income tax and national insurance. However, is not entirely tax-free. You'll likely need to pay capital gains tax when you eventually sell the shares. So as UK shareholders, you're always subject to capital gains tax. There will be something to pay on the gain. However, you can avoid paying the top rate of capital gains tax. So EMI, so that's the Enterprise Management Incentive Scheme, are particularly tax-friendly for recipients who benefit from a lower rate of just 10% on any gains over and above the value that's agreed with HMRC when those shares are sold, so long as the sale is at least 24 months after the grant of those options. So this is known as Business Asset Disposal Relief, previously known as Entrepreneurs Relief, and the rules are slightly relaxed for this incentive scheme. So this is why share schemes make for such brilliant incentives compared to the standard amount of tax that you would pay if you were to receive an annual bonus versus getting free shares or shares at a lower rate, especially for top earners who are in that higher rate tax band. So other scheme types don't come close to this sort of tax option, but they do have different tax implications and can be used in different ways. So to be absolutely clear, in the UK, there are 3 tax points that are due for recipients. So the first is on award, and that would only affect ordinary shares. On exercise, that would affect options. And then on sale, and that's always due on shares. The 2 different tax types that generally apply with an extra bonus for qualifying entrepreneurs. So your first is your capital gains tax, and that's normally between 10 to 20%, and that's due on the sale of shares and is applied to the gain in the value of the shares from the point when they were originally granted or given, or in the case of options, on any gains in value over the price paid on exercise. If you qualify for business asset disposal relief, like I said, you'll get a nice 10% capital gains tax rate. The second type of tax is income tax, and that's typically between the 20 to 45%, and that's based on your current tax band, and that's due at the point that the option is exercised, and in some cases it's due on sale.
Thank you, Erin. Let's move on to the last tip, which is rent-a-room relief. Rent-a-room relief is designed to provide exemptions for low levels of rental income from a lodger in an individual's home. It removes the requirement to notify for rental income below a certain threshold and simplifies the calculation of profits when income exceeds that threshold. Conditions for rent-a-room relief are that the income must be otherwise taxable as trading income or property income. The accommodation criteria are that the accommodation must be furnished, it must be a UK residence, and the individual's only or main residence for all or part of the income period. The meaning of residence is that a residence includes a building or part of a building intended for separate residence, such as a caravan or a houseboat. Whether a property is the individual's only or main residence is determined by the factual circumstances, considering factors like the length of occupation and intent. The individual's limit for rent-a-room relief is £7,500 in a tax year. If another person is entitled to the income, the limit is halved to £3,750 each. The limit is not prorated for an income period less than a full year. Gross receipts and options. Up to the individual's limit, so gross receipts equal to or less than the individual's limit are automatically exempt from income tax. The individual can elect for normal business income principles if there is a loss. If the gross receipts exceed the limit, there are two options allowed: to calculate the profit or loss using normal business principles, or to elect for the profit or loss to be calculated under rent-a-room rules, restricting taxable receipts to the excess over the limit. Rent-a-room relief is a useful tax provision for those looking to earn additional income through renting out a room while enjoying simplified tax treatment for modest rental amounts.
Thanks, Victoria. Our final tip of the day is around inheritance tax, so the 7-year rule and some more. This is my favorite part of tax. So the scope of inheritance tax is extensive, and there are numerous valuable reliefs and planning strategies linked to succession planning. I'm going to go through some key details for making tax-free gifts. Again, it is a tricky area, so always do seek professional advice. So the first is £0. That's the amount of tax that's due on gifts to your spouse or civil partner. 7, that's the number of years you have between gifting something to an individual to ensure it's tax-free. This is known as a potentially exempt transfer. £3,000. This is the total amount you can gift tax-free in a tax year. This is referred to as your annual exemption. £250. This is the maximum amount you can gift tax-free to an individual that hasn't benefited from your annual exemption. £0. That's the amount of tax due on gifts given for maintenance of old or infirm relatives. 18. The age up to which you can gift your children with maintenance for their education or training, tax-free. £5,000, the amount a parent can gift their child tax-free for their wedding. £0, the amount of tax due on gifts to charities or political parties. We're now going to do our final polling question before Victoria takes us through a specific service that SAIL offers to help with strategizing your specific tax position. Victoria, if you wouldn't mind getting that poll up.
Okay, the last poll is, okay, it should be up now. Our last poll is which relief applies to you. This is a multiple selection, so please do choose even if there's more than one, or none if none applies to you. From the following options, you can choose multiple. Which reliefs do you think you could benefit from and reduce your tax bill? We've got pension, carry forward, company car, home office, personal saving allowance and starting rate for savings, transfer of assets, individual savings accounts, inheritance tax, research and development, and creative sector relief. Okay, we'll give you guys a few minutes to answer that. One more minute, the one's almost finished. All right, I think that's mostly everyone. We can end the poll and share the results. All right, it looks like 83% of you would benefit from a pension scheme relief, 33 of you from the company car, 50% of you from the home office, some for the personal savings allowance, inheritance tax, research and development, and the last would be transfer of assets. Good to know. All right, let's move on. All right, so I want to chat to you about our specific service, which is called a health check. We want to help you unlock your financial potential with our tax and financial health check services. At SAIL International, we understand the importance of a robust financial strategy and optimal tax planning for individuals and businesses alike. Our experts will assess your tax position, providing a visual representation of the meter, as you can see on the screen, to illustrate your current standing and helping you move further into the green with our expert advice and guidance. We specialize in conducting comprehensive assessments that delve into your historical, current, and prospective financial landscape. By leveraging our expertise, you can optimize tax efficiency, mitigate financial risks, and receive strategic insights and a roadmap for long-term growth and goal attainment. Our streamlined process includes a thorough review of your tax position to ensure compliance with the latest regulations. Personalized recommendations tailored to your unique circumstance will empower you to make informed decisions with confidence. Take the first step towards financial empowerment and contact us to schedule your tax and financial health check assessment. Thank you for being a part of our UK Tax Tips webinar. We trust you found the session informative and valuable. We do wish to extend an invitation for you to capitalize on a 15-minute no obligation consultation with us. Should you have a particular tax tip that caught your interest, do let us know and we'll gladly furnish you with more detailed information. I want to wish all of you a wonderful and prosperous week ahead.